Good day, YouTube. This is Jay Money with Falling Forward Financial. Just a 3 growth stocks here, down 81 to 90%. Some you might already own, some you might want to consider. Not that I give tax, legal, or trading advice, just stating my opinion. But they look pretty decent. So first, Redfin is taking a growing share of U.S. residential real estate sales. And we'll go over these a little bit more in detail. Unity Software's opportunity in the gaming market is worth $336 billion right now. Shopify continues to grow its presence in the direct-to-consumer e-commerce industry, both organically and through acquisitions. So, just a while back, Shopify was, well, I think it was last year at some point in time, $1,500, and they did their split now, so we'll go over the price and everything. But stocks that fall that much as 90% do carry inherent risk, but given that investor sentiment toward the technology sector is so negative right now, there's no doubt some beaten down companies represent enticing long-term opportunities. Be warned though, interest rates are likely to continue to rise, and geopolitical tensions will breed further uncertainty, so the next year or two might not be smooth sailing. So definitely not why the administration is in that we currently have. So once they're out of there, I don't know if I foresee anything changing, so possibly getting worse. But 3 Motley Fool contributors have identified Redfin, Unity Software, and Shopify as stocks to buy right now, while they're trading at heavy discounts to their all-time highs, but focus on the long run is key. So, a contrarian play, Redfin is an economic environment that features rising interest rates. Usually isn't the best time to buy real estate-oriented stocks. Rising rates often lead to softer house prices because buyers can't afford to borrow as much money for their mortgage. But Redfin stock is so beaten down right now to the tune of 90% from its all-time high that it's starting to look incredibly attractive. So first we have Redfin here. Looks like about a month or ago was right at 11 and just slipped down to probably the $6 or $7 range. Ran back up. Right now it's at $9.27. This has got a $1 billion market cap. Today's range at $9.25 to $9.96. 52-week range of $7.13 to $63.64. So it's been quite volatile. So a volume of 2.4 and an average of 3.5 million. Company is focused on its long-term strategy of representing an increasing share of homes sold across the United States. Its primary business is brokering, with the army of 2,750 agents across the country, delivering a level of scale that smaller independent real estate firms can't match. It's how Redfin is able to charge listing fees of between 1 and 5%, or 1 and 1.5%, compared to the industry norm of 2.5%, saving its customers over $1 billion to date. So 1% in this market is a lot. So even 1.5, it doesn't sound like much, but if you have $100,000, $200,000, $500,000 home, that all adds up. So in the recent first quarter of 2022, Redfin represented the sale of 1.18% of all homes sold in America. Since Redfin's 2,750 agents comprise only 0.09 of the total 3 million registered agents in the United States, it's performing with extreme efficiency. And if the prices and everything stay the same way, I could foresee going up, just because they don't charge as much of a commission. That's just my point of view on it. So, but the iBuying is a process that involves Redfin purchasing homes directly from willing sellers with the intention of flipping them for a profit. which works great in the rising market, but the company has $245 million in inventory right now that could fall into the red if interest rates place too much pressure on prices. The company is growing rapidly over the long term. It has increased revenue by a compound annual growth rate of 50% between 2017 and 2021. So, like I said, could grow even more, and analysts expect further growth in 2022 with revenue potentially topping $2.5 billion. Investors with a short-term mindset might want to steer clear of Redfin because of the challenges ahead, but for those focused on the next 5 or 10 years, the stock could wind up being a home run. So just have to wait and see. So next is Unity Software. Investing in Unity Software in 2022 has been painful to say the least. Shares of the leading game development platform are down more than 82% from their all-time high, with substantial portion of the drop coming from a disappointing first quarter earnings announcement. So here you can kind of see the chart, probably about the $43, $44 range. Slipped clear down to 33, ran back up to 45, and it's been kind of all over the place. Currently at 41.29, $13 billion market cap, days range of 40.61 to 43.30, 52-week range of $29.09 to $210. So it's quite the range there. More volume on this one at 5.5 and average of 10.3. Unity runs a game development platform that allows developers to do everything from building a game to monetizing it. Game development features are primarily subscription-based models, while it operates solutions which allow developers to grow and monetize their games are primarily served through consumption-based models. In the most recent quarter, management noticed issues with the monetization service. The company's artificial intelligence that drives developer monetization was inaccurate due to bad data ingestion. As a result, Unity will have to start from scratch and gather new data, which the company anticipates will be worth $10 million, hit to the top line for the rest of the year. At 11 times sales, Unity trades near its lowest valuation since coming public in 2020. Unity can get its monetization service up and running again, then shares will be a steal right now. So if you know much more about this one, or if you have this one, go ahead and list it in the comments, or any of the stocks we're going to go over, you can list that as well. So but it could be a rough ride for investors for the rest of the year, but these prices look attractive for long-term investors who want to invest top dog in a gaming market worth $336 billion. So empowering direct-to-consumer businesses. Shopify this year, 64% of the consumers will buy directly from brands on a regular basis, up from 49% in 2019, according to eMarketer. That reflects the growing importance of a direct-to-consumer business model compared to marketplaces like Amazon. Models afford sellers more control over the buyer experience, giving them the opportunity to build lasting customer relations, and Shopify is leading the charge. Currently at $33.04, a $43 billion market cap, days range 32.75 to 35.31. Could even trade this one, might be kind of interesting. The 52-week range is 29.72 to 176.29. That's probably back when it was pre-split at $1,500, I'm sure. Lots of volume on this one, 25.7 with an average of 44.4. Here you can kind of see the volatility in it. About the $39, $40 range, went clear down to 31. It's just been kind of volatile in the last month. But they offer commerce software and financial services that enable businesses to operate across physical and digital channels, including branded websites, mobile apps, and online marketplaces, the value proposition has attracted over 2 million merchants to the platform, and Shopify ranks as the leading e-commerce software vendor in terms of market presence and user satisfaction, according to recent G2 Grid report. Despite tough comps and high inflation, Shopify will still delivered respectful financial results over the past year. Revenue climbed 40% to $4.8 billion, and the company generated a positive cash flow from operations of $315 million. As a caveat, cash from operations fell 51% compared to the prior year. However, management's growth strategy should give investors confidence. Shopify recently acquired Deliver for $2.1 billion, accelerating its plans to build a nationwide fulfillment network. Shopify's warehouse automation technology, collaborative mobile robots to streamline fulfillment. Ultimately, the Shopify fulfillment network will empower merchants to offer 2-day or next-day delivery across the United States. That should further differentiate Shopify from its rivals, and it should help keep their merchants. So currently, Shopify stock is 81% off of its high, and shares trade at 8.3 times sales, an absolute bargain compared to their 5-year average 30.4 times sales. That's why now is an excellent time to buy this beaten down growth stock. So I've been watching Shopify, and I picked up a couple shares and going to be picking up a couple more, so, and just kind of see what it does. It's definitely a long-term hold, so I mean, if you could get back to that $1,500 level, or even the 176 that it was, that would be a good bargain. So good return on your investment. But that's it for this one. If you have any of these, like I said, go ahead and list it in the comments. Again, I don't give tax, legal, or trading advice, just state my opinion. And if you haven't smashed that like button yet, go ahead and hit that for me, as well as subscribing, and hit the bell so you're notified of when the next videos drop. Again, this is Jay Money, Falling Forward Financial. Happy trading, happy investing, stay green. Cheers.